My name is Jake, welcome to the channel. And today's video, I want to talk about extending your runway if you're a dividend investor and what that means. There's a lot of turmoil in the market right now. If you're investing in the stock market, it's kind of been a bumpy ride. And I want to talk about a few things that are on my mind when it comes to extending your runway. Now, if you've never heard of this term, I think this is going to be an interesting video for you, especially if you're a new investor or a new dividend investor. What that means, extending your runway is so important because when you don't, bad things happen and it could look a little like this. So my portfolio the last couple of weeks been quite a roller coaster. All time, my portfolio is down. At least since I transferred money over here in September, it reset the history. But just in the last week, I look at the performance. My portfolio is down over $30,000. Absolutely incredible. The market sell-off really started here last year with unprofitable growth stocks, high valuation stocks getting sold off first, and then it was small caps. Now it's been, the large cap growth stocks. You're seeing companies like Netflix and others just get annihilated. And now here this last week, it's been dividend stocks. Dividend stocks have been selling off. It might be a little bit easier if I show it visually here. This blue line, the bottom one, this is IPO. This is an ETF that tracks companies that just went IPO. The yellow one here, or the orange, I guess, it's the Vanguard S&P 500 growth index. So it's larger growth companies. You can see that this one has now, the yellow one, yellow-orange, has been going down significantly in the last couple of weeks. And then this teal color, light blue teal color, is the S&P 500 value. And it's pretty much on par with Noble, this darker orange here. But what I want to show you is, since the beginning of the year, what's really started selling off were more speculative, high growth or high multiple stocks. And then it's trickled into just the growth stocks in general. Netflix really comes to mind. And then just recently, you see this here in April, this is where you're starting to see quality value companies start to get impacted with this sell-off. And so it comes to mind where there's really no place to hide. And if you look at the performance year to date from, the different sectors, the only sector holding up this year is energy. The only sector in the green this year to date. So cyclicals, technology, more of your discretionary sectors are getting hit the hardest. Now, on the flip side, when the market was booming, these sectors were performing the best, right? So what I'm saying here is this is a good representation that every part of the market is getting impacted with this sell-off. And yes, it's been impacted, each sector or different pockets of the market have been selling off differently. But what I want to say is, I think, I don't have a crystal ball, but I think this is going to continue for some time. And so when I think about, here, let me kind of share with you some of the thoughts that I have here. If I look here with the pandemic, right? The downturn the pandemic lasted. It was the shortest recession pretty much ever recorded. 1 month, and we're pretty much jumping right back up. This super V, I guess you want to call it. This is what we saw here during the pandemic. And a lot of new retail investors, you and I, got into the market and we saw this and we thought, wow, okay, the market only goes up. But what's interesting is when you look back in history and you see how the market has recovered over, over decades, the story looks a little bit different. So back during the financial crisis, you look at, for example, October 2007. It took over a year, almost 2 years for the market to bottom. 2 years, right? That is significantly longer than 1 month, right? And so I just find that so fascinating because back during the financial crisis, yes, I was investing, but I was still going to college. I didn't make a lot of money. And so it didn't really impact me as much in terms of the stock market. And then you look back here during the dot-com bust, right? You look at the top of the dot-com bust all the way down here. It took what, almost 3 years, a little less than 3 years for the S&P 500 to bottom, right? But here what's interesting is, each index performed differently, right? So you look here, you can see with the NASDAQ, it took 2.5 years for the NASDAQ to bottom and then to start recover. You look at the Dow Jones, and this one's a little bit different because it held on a little bit longer, but it took years for this recovery. And what makes me think about this, the reason why I'm bringing this up is I foresee this market downturn that we're in. I think it's going to be a longer down cycle than what we've been used to these last couple of years. Okay. And I go and you look at Google Trends, for example, recession. People are searching recession more now than they have in years, right? Now you had a spike during the pandemic. You had a spike during the financial crisis. But here in the US, it's pretty evident that recession is on a lot of people's minds. And if you go worldwide, it's pretty clear that recession is on a lot of people's minds. They're searching the topic of recession more and more. So this got me thinking, okay, well, if I understand that we're probably in a market downturn, and this may last a little bit longer than what we've seen here in recent history or the recent past with the pandemic, what are some things that should be on our mind? The first thing that comes to mind when I think about a market downturn is I think about valuations. A valuation of a company, a business, an index is usually calculated in most cases by the price to earnings. It could be a little bit different for REITs and other parts of the market, but the most common way of valuing or viewing valuations is through the PE ratio, and the PE ratio here in 2020 is still pretty high. It's at a 20. When you look at this historically, it's at a pretty high, we're at a pretty high PE. But the thing that I want to make sure that everyone kind of understands, that a 20 PE historically is high, but you have to understand that the S&P 500, the makeup of the S&P 500 today is very different than it was a few years back. When you look at the S&P 500 today, more than a quarter of the S&P 500 is made up of technology or information technology stocks. And these companies generally trade at a higher PE because the majority of them, they're in growth mode. And so what that is it's looking at future cash flows, discounted cash flows in the future. And it's not really valued at a lower PE because the value of these companies are in years into the future. And then when you have inflation into the mix, it kind of throws everything off. Okay, and so when you look at the S&P 500 makeup today, the majority are technology companies, and when you look at that historically, that really hasn't been the case. So we're in this kind of weird area in the market where times are different, but when you look at charts and you look at where the market has traded in the past and the valuations, it's kind of a weird time. And I don't have the answer, but I think realistically that we're going to see an S&P 500 PE ratio of about 15. I think a 15 is a conservative amount for technology stocks. A 15 PE is actually a pretty good PE ratio, given that the S&P 500 is made up of such a disproportionate amount in technology companies relative to history. Okay, so that's kind of something that's on my mind. Some things that are, I'm kind of thinking about and where we're at in the economy and the market today. Now, there definitely is a benefit when you see the market go down. That means that there's value to be had, right? In most cases. One example that I really like to look at is with SCHD, the Schwab, dividend ETF here. This is my favorite dividend ETF. This ETF is been pretty under a good amount of pressure, but the thing that I love seeing about SCHD is it's currently trading at over a 3% dividend yield. So if you were to buy SCHD today, you're getting a forward starting dividend yield of 3%. Whereas, for example, if you would have been buying at the beginning of this year, you would have been getting, just about 2 3/4 dividend yield, starting dividend yield. So That's something that's really exciting for me as a dividend investor. When I look at all this market turmoil, there's always an opportunity to be had when you see this, right? When you see that there's blood in the streets, it's important that you understand, right? With this type of turmoil, there comes an opportunity. But in order to capture the opportunity, you have to be in the position to take advantage of that. And so that's what I want to talk about. The remaining part of this video is talking about ensuring that you're able to extend your runway and be able to capitalize on this opportunity. So what I found really interesting is the Y Combinator email to their founders was leaked or released, and the public had access to it. And I found it really, really interesting because this kind of fits into the whole message that I'm trying to explain here and why it's so important to me. So Y Combinator, they invest into startups in Silicon Valley. A lot of high profile companies like Stripe, for example, they've invested in those type of pre-IPO companies out of Silicon Valley. But what's interesting is they work with a handful of startups, and their portfolio, they speak and are in connection or in conversation with different founders all throughout Silicon Valley. And they sent an email to all of their founders and talked about this runway and to plan for the worst. And this email became public, and I think it's so interesting. And there's a lot of things that I think you and I, just your normal person, can learn from this. Okay, so I want to read part of this, and I want to highlight a few things, and I'm going to tie it back to why it's so important for you as a dividend investor and why I'm thinking in a certain way, and it'll make a little bit more sense here in a second. So to start off, they write here, during this week, we've done office hours with a large number of YC companies. So this is, the different startups that are in their portfolio. And they're saying that they reached out to ask whether they should change their plans around spending runway, hiring, and funding rounds based on the current state of public markets. So keep in mind that YC, they're focused on pre-IPO. So these are private markets. And what we've told them is that in economic downturns often become a huge opportunity for the founders who quickly change their mindset and plan ahead and make sure their company survives. Okay, so there's a couple of things here. When a market downturn approaches us, it kind of can happen out of nowhere. Some people can see it coming, most people don't. And when you're faced with a market downturn, you have to shift your mindset and your approach rapidly, otherwise you're not going to survive. And that's when we're talking about your runway, if a plane has a long runway to land, it's much safer. The alternative would be if a plane has a short runway, obviously it's going to be more dangerous and more difficult to land the plane safely. And that's what we're talking about here when we talk about, having your runway and extending your runway. Okay, so there's a couple of points that I think are so fascinating that I want to read from this email. Their first point here is that no one can predict how bad the economy will get, but things don't look good. So they're saying is there's a lot of uncertainty, there's a lot of FUD, fear, uncertainty, and doubt in the market right now. And no one really knows what the future is going to hold and what it's going to look like. And so things are looking pretty grim. That's what they're saying. But this second point I think is the most important. The safe move is to plan for the worst. If the current situation is as bad as the last two economic downturns, they're talking about, and most notably the pandemic, but really actually the financial crisis and the dot-com bubble is I think what they're mostly talking about here. The best way to prepare is to cut costs and extend your runway within the next 30 days. Your goal should be to get to default alive. So default alive is the key thing here. Default alive means that you're surviving, that you're able to survive on your current, talking about the startups here who are, the founders of the startups addressing this email. They're saying that things are going to get pretty bad, really, really bad. We don't know how bad, but the right approach here is to be ultra conservative, cut costs, extend your runway, and to reach default alive. Default alive is the key thing here so that you're surviving, right? You're not going under. In a market downturn, one of the best things that you can do is to survive. Because a lot of companies, a lot of people don't survive a downturn. So Being default alive is the most important thing. And in a moment here, I'm going to share with you 5 things that I'm doing to ensure that my wife and I, that we're default alive. And there's a lot of other interesting things here in this email, but another one that I want to highlight is point number 4. Regardless of your ability to fundraise, this is talking about startups, it's your responsibility to ensure your company will survive if you cannot raise money for the next 24 months. That is incredible. What they're saying here is that you need a runway up to 2 years. Now, during the pandemic, the downturn was about a month, right? And then it just, that V-shaped recovery, everything just shot and ballooned up. In this market downturn, to be conservative and plan for the worst, they're advising to plan for the next 2 years. And that's just, for me, that's just incredible. It kind of goes back to what I was saying, when you look at the financial crisis and the dot-com bubble, those downturns, there was no V-shaped recovery. It took years for there to be a bottom and for there to be a recovery. So in this case, reaching that default alive is the most important thing that you can do in a downturn that lasts more than, a month, but rather 2 to 3 years, for example. The next point here, which is really interesting, is point number 6. For those of you who have started your company within the last 5 years, question what you believe to be a normal fundraising environment. Your fundraising experience was most likely not normal, and your future fundraisers will be much more difficult. So how this relates to you and I, as new investors, if you just started investing these last couple of years, the last 12 years, we've been in a bull market. If you've started investing after the financial crisis, you pretty much only know up and to the right. Now, there was a few down years, but for the most part, it was a very easy environment to invest in the stock market. And what they're saying here is if you've only been invested for a couple of years, you don't know what normal is, and you better bunker down and really focus on default alive. All right, and the last one that I want to share is number 9. Remember that many of your competitors will not plan well, maintain high burn, that means they're spending too much money, and only figure out they are screwed when they try to raise their next round, so when they try to get their next round of funding. You can often pick up significant market share in an economic downturn by just staying alive. So when I read that, in a market downturn, half the battle is really just staying alive and maintaining that status of default alive. If you're not default alive during a market downturn, you're dead. And now obviously that's a little bit over dramatic in that sense, but financially you may be ruined if you over leverage and if you don't de-risk your portfolio or the way that you're approaching this market downturn, because you might be caught by surprise. And I think as this email stated here, a lot of people are going to be caught with their pants down, and they're not going to be alive in a financial sense when it comes to a prolonged recession or a prolonged market downturn. Now I want to share with you how I am viewing default alive and what my wife and I are doing, or what we're prioritizing to ensure that we keep this default alive mindset and status. Okay, now a few things that come to mind. The first thing is having a healthy emergency fund. Now, an emergency fund can be anything from 3 to 6 months of your core expenses. So that could be your rent, your mortgage, your car payment, your credit cards, your student loans, whatever your fixed costs are, making sure that you have 3 to 6 months of core expenses covered. The last thing that you want is to have to dip into your portfolio, sell your portfolio at a distressed price. That's not something that you want. So maintaining a healthy emergency fund is absolutely key in order to stay default alive. The second thing is keep your expenses low. You really want to limit your discretionary spending. If you're thinking about going and buying a brand new boat or an RV or something like that, you're thinking about going on a vacation, and you're kind of on the fence, well, it would be nice. Do I really need it? Keep your expenses low and limit your discretionary spending. The third thing is avoiding over leveraging or taking on excess debt. If, for example, you have a mortgage on your current home, don't think about just right away going and getting a second mortgage. Don't look to over leverage. Don't look to, build up credit card debt. Don't take on more debt than you can reasonably afford. Don't live within your means, live below your means. And really, that is the key thing to staying default alive, is not over leveraging yourself and being stuck in a very uncomfortable position, a year from now, and not really having anything else to do than sell your stocks or your positions at a distressed price. That's something you don't want. The fourth thing is to change your habits. Change your mindset, limit your want-based purchases, and focus on need-based purchases. It kind of goes back to what I was saying with point number 2 with discretionary items. If you don't really need it, reconsider buying it maybe in a couple of years. And that's the key thing. It's really a shift in your habits and your mindset and asking the question, do I need this or do I want this? And in most cases, if you want it, you should reconsider it if you're financially able to do it. The fifth thing is, this is probably the most important thing on my mind when it comes to default to life, is focus on job security. What you don't want to do is you don't want to go and lose your main source of income. You don't want to have to go in and sell your stocks out of a last resort because you don't have a source of income. So the top of mind thing for me at this point in time is maintaining my job security and focusing on having income coming in every single month so that we're not having to be forced to sell our dividend stocks at a loss. That is the most important thing for me when thinking about default to life. You have to maintain job security. Thank you so much for watching, everybody. I hope that this video was helpful. This video is a little bit more on the serious side. It's really important that you have that mindset and you maintain default alive. If you are watching this video and you're married, you have a relationship, you're a partner, make sure that you have that conversation with your significant other and put together a plan to make sure that you maintain that status of default alive. I hope that this was helpful. I hope that you learned something new, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.